Well, good evening, everyone. Thank you all for joining us tonight. We are going to deal with the elephant in the room tonight. We're going to talk about finances. So, if you would go ahead and share and start a couple of watch parties, and you know the drill. I'm going to try and share it on my professional page so that I can put it on my other page. So let's see how that goes tonight. Um, and then we'll get started. So just give me 1 second before we get started. I'm trying something new, so just hold on.
Sonya, how do I share it on my page?
You can log on to your page and log on to STC Rally Facebook. I mean STC Cruel Facebook page.
All right.
And you should see it.
And then I'll share it there.
That would be fantastic. Wow, we have some people already on. Thank you all for joining tonight.
How do I share from here, Sonya?
Well, if you go to my page, you should see us. Do you see us on your okay? And then does it have a place where you can start a watch party or something like that?
Mm-hmm.
And you can do it that. Just start a watch party.
Let's get it.
All right. Fantastic. So, Miss Butler, if you would share this to my other page, since I am unable to do that. We're going to have to work on that. But anyway, welcome to everyone that's on with us tonight. We are excited about our conversation. We're going to be talking about money and mindset tonight. I know it's a hot subject, and a lot of us don't like to talk about it. Hey, Pam, thank you all for logging on. And Yolanda, thank you for being here tonight. I am very excited to have with me one of my really, really, really good friends, somebody that I trust with all of my millions of dollars, all of them. I trust him with my money. He has not steered me wrong yet. He is my confidant. He's a really good friend. He and his wife and his kids. I love them dearly. It's just like they're just an extended part of my family. They're a part of my family. And I'm so glad tonight to have on with me. He is a minister. He's an armor bearer. He's a preacher. He's a financier. I am excited to have on tonight, Mr. Earl Moton. Earl, how you doing?
I'm doing wonderful. Thank you, my sister, for inviting me on.
I am so excited for you to be here tonight. Your sister has already told me that she was going to be on, so I will be expecting her any moment. And so how are you doing? I know we talked earlier when the pandemic was just getting started. I think we talked about fathers, Black fathers. I think that was a topic back then. But how are you doing since we're 9 months, 10 months into this epidemic? How's it going?
It's going well. It's going well. Taking it slow, day by day. Mm-hmm. As we say at Berea, we say keeping it safe, sanitized, and staying sane.
Okay, safe, satisfied, and staying sane. Okay.
Sanitized.
Sanitized.
Yes.
Come on. That's the truth.
That's right.
That's the truth. That is, I mean, you love people, but you still need to put on your mask and love them.
Exactly right.
Masks are just really, and I don't get offended when somebody put a mask on around me. I'm cool with it because I want you to be safe and I want to be safe. I really, really believe in that. So how's the family? How's Jan and the kids and how's everybody doing? What are they doing?
Everyone's doing well.
Good.
Jan's working. Manny is our middle son is in Minnesota. He's in school. He graduates in May. with his bachelor's. He's going right into law school. He's going to be a sports attorney. And Earl E., our oldest son, he's still writing his book and working part-time with Danielle. And Janelle's a junior in college, and she's doing well also. She's an RA this year. So everybody's doing well.
Wow. So y'all are really empty nesters. Oh, my goodness.
Yes.
Wow. I hope you all are enjoying this time.
Yes.
Yes.
Absolutely.
That's fantastic. Well, let's get into our conversation. I know that, let me tell you something. This Earl is someone, hey, Curtis and Gloria, thank you all for joining. Teresa, thank you for joining. Earl is someone that every year when I do I update my financial information and I do my beneficiaries and all of that stuff. I always send him a copy and Danielle a copy. Because I know if something happens to me, Earl may be sad, but he's going to be a little more level-headed than me. So I always, and anytime I'm making any financial decisions, whether large or small, I always run it by Earl, and he always gives me very, very sound advice. And he's just been a blessing in my life. And I thought, why just keep this blessing to myself? I want to share it. He works with a lot of people I'll tell you what, go Earl, you tell us about your business.
Well, I've been doing financial planning and retirement planning now for 30 years. I got my license in 1990 and started my company in 1991. And we've been truly blessed. We handle finances from A to Z. Basically, from financial planning to retirement to insurance, everything that a person would need to cover their families, whether it's financially or insurance-wise, we can do that. I will say this, we cover people, but not property and things. So we don't do like car insurance and things of that nature, but we do full financial planning. And we count it a privilege and an honor for someone to allow us to service them as their representative, as their financial planner.
Wow, thank you. Turn your volume down on your phone.
Okay, my phone is, let me turn that, it's off.
Oh, okay, well, I don't know what that noise is. Hey, Janice, thank you for joining us. Hey, Gloria, hey, Linda, thank you all for joining us tonight. So when we talk about finances and when we talk about money, how can we, I guess the first question, how can we stop living from paycheck to paycheck?
That's a great question. The funny thing about money is it doesn't come with instructions, but it comes with rules and principles. If you understand the rules and principles about money, you'll be able to operate a lot more effectively with it. Never do you get paid, and when they give you the money from the bank, do they give you an envelope with money and a list of instructions on what to do with it?
Right.
That's up to you. And the main thing I would say to help people to move from living from paycheck to paycheck is simply a budget. Everyone needs a budget. And what a budget is simply a roadmap to tell your money where it's going. If you don't have a budget, you won't keep your money for long.
Wow. So when we're talking about budget, now let's define that. So this budget that we create, sometimes people create budgets and it's so narrow and they feel so confined that they can't, do anything extra. So when we're talking about budget, how do we even establish a budget?
Well, and it's funny you say that because a budget is designed to confine you and to constrict you. If you don't have a budget, you're just going to spend till it's gone, right? And then even more. Basically, what you want to do when you look at a budget, you want to track your spending for 30 days. Mm-hmm. One of the biggest mistakes people make is that they set a budget and then they try to live to the budget without tracking their spending first. Mm-hmm. And a lot of times when people come in my office and they sit down, I tell them, do you have a budget? So they break out a piece of paper all excited. This is my budget. And I go down and I look at it. I say, that's not a budget. That's your bills. And basically the difference is this. If you write down the bills, just your bills and what you owe, and you pay all your bills, you still can run short on your money because you're not tracking your spending. All you're doing is showing me what your bills are and what you pay, but you're not showing me how much money you spend every month. So that's why it's imperative to do a successful budget is to track your spending for 30 days first. whether you get a donut in the morning, whether you get coffee, your dry cleaning, everything that you do on a normal basis. If you on Fridays, you stop by the sports bar and get some wings and soda with your friends, you have to write all that into your budget, because if you don't, you'll have mortgage, car note, insurance, cell phone, all your bills. But then, and that says that's $2,400 a month. But at the end of the year, end of the week, or end of the month, you've allocated $2,400, but you spent $3,000.
Wow.
So you're always out of budget. And then people say, I have a budget, but it's not working. But the challenge is it a correct budget? And that's one of the things that most people fail to do is to track their spending before they do that. And there's many things you can look at. And I'd like to go a little further as we move forward in regards to how you do a budget.
Well, go ahead. Hey, I'm just asking the question because I know you're the expert. How do you do a budget?
Well, you want to track your spending for 30 days. Mm-hmm. And then one of the major mistakes that people do is that's the first thing. The second thing is they say they have a budget in their mind. If you have a budget in your mind, that's called a wish list. You ever went into a grocery store and you didn't have everything written down that you was going to get? And when you came out, you had eggs, bread, milk, and cheese on your mind, but you came out with cookies and potato chips and candy and ice cream. Why? Because your mind changes on a regular basis. So if it can change from your car to the grocery store, imagine what it can do over a 30-day period. So you need to write down everything that you're going to spend money on. And the funny thing about a budget is people say, well, I might not be able to get that this month. Great. You have another 30 days next month. And then you try to spend it in that month. And in your budget, what you want to do is create enough room for what we call miscellaneous items, which would be your girlfriend calling you up and say, hey, it's my birthday. Let's go get something to eat. And that might be $50 to $100. Everyone's budget is going to be different. It's like clothes. When I share with people, when I sit down with them, I'm a financial tailor. So I make your budget fit you.
Wow.
What I do for you, I may not be able to do for your neighbor, your or someone else. And that's very interesting. A lot of people do their budgets based upon their coworkers, their sister, their brother, and that's not really going to be necessarily effective for you. It might be effective for them, but not necessarily effective for you. So you want to track your spending, you want to write it down, and then you want to begin to itemize who you owe, what you owe. I don't want to get into interest rates and all that, but you want to write down what you owe. Also, you want to write down your income, what you actually make, not what you want to make, not what you think you're going to make, not what you expect to make, but what you actually make, what's deposited into your account. And once you have that number, let's say a round number of $2,500. So once that's deposited in your account, you know that's what you have to work from. And I try to tell people, don't use what they call it, temporary income is what we call temporary income. What that means is overtime, bonuses, things of that nature that's temporary. Because if you don't work overtime and you have a budget, that budget might be $2,800 or extra $300 a month, but they cut your overtime out 3 months later, then you're out of budget.
Yes.
And the other thing that has changed the financial planning landscape over the last, I guess, 7 or 8 years has been gas. You can go to sleep and gas is $2 a gallon. You wake up tomorrow, it's $2.10 a gallon. So you've done nothing different, but now your budget is out of whack if you didn't create enough fluff in it for that 30 days to make that difference or that challenge.
So as we're looking at budgets, and I know that generally there's a budget pie, if you will, of how much you should spend on your mortgage, how much you should spend on a car. What's the percentage that out of your budget should be for mortgage? What's the percentage that should be for car payment and all of that? Can you talk a little bit about that?
Sure. And it's funny when you say that, because the biggest challenge for people is they already out of budget. So when if I come in and tell you, listen, you're only supposed to have 25% of your income going to your house and 10% going to your car, when you got 30% going to your car and 40% going to your house, and you got a 30-year mortgage and a 5-year car note. So, how do you fix that? Yeah. So a lot of that is, especially, and I'm just going to be real, in the African-American community, is different than when you see on TV and they say, well, 25% is for your home allowance. 10% is for your car allowance, and so much is for insurance and all that. That's a way to do it. But what I like to do is this. I like to sit down with a person, find out what they make, and then let's begin to cut the pie based upon your income. Because a lot of that looks good on paper if you're making $100,000 a year. You can slice it up a lot of different ways. But if you're making $30,000 a year, that's a little different when you got to have a house and car note and insurance and cell phone and food. You know what I mean? Just the basic necessities. So percentages are good. And ideally, if you wanted to cut it up at 100%, and again, you mentioned when we first started that I'm a minister. So if this is a biblically based answer, if you are a believer, 10%, you're supposed to live on 70% of your income, and 30% you're supposed to set aside. Now, 70% is what you're living on, your expenses. 10% is going to tithe, 10% is going to saving, 10% is going to giving away or investing. 70% is what you live on. 10% is what you tithe, 10% is what you save, and the other 10% is give or invest. That would be ideally. Now, if you look at most people, if you tell them to live on 70% of their income, they're going to look at you like you're crazy. Because most people are living what? On 100%, some on 110%. They borrow money each week or every 2 weeks. So they're living above their means. So in order for most people to get back in a legitimate budget that will work long term, it's going to require a lot of sacrifice, a lot of discipline. And I'm sorry to use words like that on your show, but sacrifice and discipline. And you're going to have to cut some things, like some of those cable stations, cut back. And a lot of people have done it with the corona, getting their hair and nails done every week. Things of that nature, because if you can't afford it, you shouldn't do it. But people are going into debt trying to look wealthy. And in our community, we have mastered the art of looking broke. I mean, you don't know who broke and who not. He got a whole bunch of money. She got some red bottles. Yeah, right. But she ain't got no food. You know what I mean? And that's a challenge. And I make light of it, but the reality of it is this. People want to look wealthy and want to look blessed and want to look like they got it going on. And the reality of it is that we need to put ourselves in a position so we can be successful financially. Because believe it or not, this pandemic has changed the landscape of a lot of things, which is going to create a lot of opportunities for a lot of people. Yeah. If you're prepared. Yeah. And I want to say this, I digress a little bit, but I want to tie it all in by saying this. This pandemic has put people in one of three positions. Either they kept their job, which is full pay. They've been reduced to part-time hours or working less, which is a reduced pay. Mm-hmm. Or they lost their job, which is no pay.
Correct.
So it depends on whatever situation you're in that's going to determine how you're going to move forward. So let's say a person lost their job. So a budget means nothing. They're in survival mode.
Correct.
So they need whatever they can get to pay their bills. And then as they get back on their feet, then they can go to the position where they can start saying, let me prioritize some of this money the right way. If a person's on a reduced pay, they're also in survival mode because they're trying to figure out, I was making $3,000 a month, now I'm making $2,000 a month or $1,500 a month. So they're able to pay their mortgage and maybe their insurances and stuff, but food is tight. And they're having to go to churches to get food and things of that nature. So they're having to modify, and they most likely won't be able to budget. But then there's the average person who kept their full pay. Mm-hmm. Now, they should be in a great position. Why is that? They're not driving. They're not spending so much gas. They're not going out to lunch and eat every day like they would at work. Mm-hmm. They're not spending as much money as they normally would with their friends on the weekends and things of that nature. So they should have been saving money and putting themselves in a position so they can be, come out with more opportunities than the average person would have gotten, or they would have gotten if everything had stayed the same. And then one of the things I want to say about that in lunch, when you're talking about every day and ways to save money, the average person over a 30-year career spends over $100,000 just on lunch.
Really?
Yeah, they usually eat their retirement. I tell myself, I hope it's delicious because it's gone. But the reality of it is, because you think about the average person spends between, it used to be $5 and $10 on lunch.
Mhm.
But if you get a drink and you get some chips and stuff throughout the course of a day, you're spending between $10 and $15 a day over a 5-day period, then over 20-day period a week, and
Wow.
over years and years and years, it adds up to roughly between $75,000 and $150,000 over a 30-year career. Isn't that amazing?
That is shocking. Wow.
But
That
what happens is this, Sonya, it lowers us to sleep because it's only $10 and $20 at a time. But if someone said, man, you're going to waste $100,000 on food over 30 years at work, you mean, man, I wouldn't do that. That's crazy. But if you do it in a little bit of increments, it doesn't affect you. It doesn't hurt you until at the end. So I always encourage people to brown bag it. Take your lunch. It's worth it. It could be worth thousands and thousands of dollars down the road.
Wow, that is absolutely amazing. Janice Moton says discipline is a bitter pill to swallow. Yes, it is. Everything I think about that requires discipline can be tough. I think about it more so when I'm thinking about exercising, having to get yourself up to do that every day. In even managing your money, not going to eat out, not going to one of my favorite stores, which is Tuesday morning, to see what they have on sale. I could just go walk around in there and not looking for anything in particular, but let's see what they have on sale. Yeah, right. Not saying no to that. Yeah, that requires discipline. You all, if you have questions, make sure you put your questions in the chat so that we can get your questions answered. That's why we're here tonight. If you're just joining us, I want to say good evening and welcome. Tonight we're talking about money and mindset, and we're talking with a money person, someone that knows all about money, Mr. Earl Moton. So Earl, when we talk about money and changing our mindset, how do we go about, for our community, changing our mindset about money?
Well, it boils down to prioritizing. Mm-hmm. Do you want to live successfully now, or do you want to live successfully later? Most people waste their future or do away with their future by living expensively now. And whether it's trying to send your kids to college or retire successfully, most people opt for the big house, the big car, the fancy clothes, all that, where they spend all of their money now. So when it comes to your child going to school, or you wanting to retire, or you taking a vacation, the money's not there. You can either have money or you can have things. And most people opt for things. And the mindset is this: I need to prioritize living below my means. Yeah. And in our community, in our culture, we're probably the worst at it. Because you look at some cultures, they wear the same tennis shoes, run over, a pair of blue jeans and an old T-shirt, and we're wearing the most expensive $200 Jordans. The new Jordans came out. And you don't even play basketball, but you got you can't even dunk a basketball, and you bought $200 tennis shoes. But you're trying to show people that you have money. But that goes back in historically to racism, though, how it's built into our culture. Yeah. Because we were not allowed to buy homes. We were not allowed to own businesses. We were not allowed to invest. So we had extra money. So what did we do with it? We bought fancy cars and fancy clothes. So that, we said, hey, these shoes cost $200, so he must have money. These shoes cost $200, so she must have money. But the reality of it is, wealthy people never show if they have money or not. You never know. You can tell a billionaire if he walked past you or not, because he doesn't flash the wealth that they have. Rich people or people who try to look rich always have the big watches and the gold chains and the fancy clothes, but they don't have any money in their bank account. They might have a purse worth $5,000 and don't have $5 in it. And it's challenging. How do we break that? Because you always want to impress your friends and your neighbors. But the reality of it is they don't care anyway. They talk about you whether you got a $5,000 purse or not. They still gonna talk about you. She ain't got no money. So you might have $5,000 and let them think what they think anyway.
Right.
You know what I mean? And people go out, and for men, it's cars. A brother will go out and get an $800 car note. when he should have a $200 car note and save the money. This is a rule of thumb that I've always shared in my family. Jan and I, we've gone through in our life and our marriage was this. You can't have a car note more than what you save per month. So if your car note is $250 a month, then you need to be saving $250 a month. Why? Because if you put money into a liability, you need to be putting money into an asset. That's if you want to build wealth. Now, most people don't try. They'll get a $500 car note because they can afford it when they should have a $250 car note and a $250 savings account. So it's building so that you're building wealth as well as you're building, putting money into a liability, you're putting money into an asset.
Wow. You know what? I have to tell you, I've never thought about that. Never, ever thought about that. So we have a question from Daniela. She said, salt and light. I would love to hear your perspective, if you have one, about Robinhood's decision to limit the buying of stocks for people on their app today with the GameStop situation.
Well, this is a very political move, and a lot of things are going to change moving forward. And I'm glad she asked that question. My son is in Minnesota. He's an investor. He started on Robinhood last year, and I got him going. And he was very upset today because of all the things that are going on. And I don't want to go too deep into it, but people with a lot of money make a lot of decisions that affect people with not a lot of money. And believe it or not, these hedge fund investors, they're saying they're losing money. They're not. They're making billions with Robinhood, whatever Robinhood did, and the changes that's going to be made. I don't agree with what happened today, but billionaires make the decisions with the money.
Yeah.
And they're going to continue to do that. Bankers do the same thing. All investors, believe it or not, and I'll share this with, I'm glad Danielle asked that question, because they're all friends at the end of the day. They act like they're enemies in public on media day, but when the lights go out and the doors close, they go on vacation together with their families. The guy from Lehman Brothers and Goldman Sachs, all of them are friends. Trust me. So, but the answer, that was a long story. A long way to answer that question was, I don't agree with it, but people with a lot of money make those type of decisions that protect them to make even more money.
Yeah. Yeah. So she also said, I just watched the CEO's interview not too long ago. He said it's not because they ran out of money.
They won't run out of money. They definitely won't run out of money. But the key is this. For them, let's say a billionaire thinks like this. If I lost 5% of my wealth, they panic. Because with them, they never get enough. If they could have $10 billion, but they want $11 billion. The average person can't even fathom having $1 billion, a million, more or less $1 billion. But billionaires, their mindset is a little different. It's I want more on steroids. If you understand that.
Yeah.
There are two types of people anywhere in the world where you go. Two types. They're rich people and they're poor people. Why is that? Rich people teach their family, friends, and their kids what they did to be rich or to be wealthy. Poor people do the same thing. They teach their family. So the divide continues to grow more and more. And then because it's more money, the divide is greater now. Because back in the day, a CEO making $1 million was a lot of money. Because gas was 25 cents a gallon. But now a CEO is making $500 million a year. And if they're sharing that with their kids, the divide is unbelievable. You have people who can't have food to eat on a regular basis.
Yeah.
And you have people who have hundreds of millions of dollars. And just think about it like this. Let's just say a person has $1 billion and they get 10% on that money each year, just 10% on $1 billion. They make $100 million on interest just on that money. If they don't do anything else, that's $100 million a year just on interest. So how can you run out of money? When you're a billionaire, that's a different landscape.
Yeah.
You literally, that's not you doing any business, just you having $1 billion. Wow. And there's 5 types of people. You have very poor people. They think day to day. This is important. And this is for anybody who's watching. We're talking about mindset. How do you think about money? Very poor people think day to day. They're on the side of the road begging. I just need some money just for today. Poor people think week to week. They rent a telephone, they rent their furniture, they rent motels from week to week. Middle class people think month to month. They pay their bills, mortgage every month. They pay the car note every month, cell phone. They think month to month. Then you have rich people. They think year to year. Well, I'm going to make $1 million this year. I'm going to buy this property this year. And that's their mindset. At the beginning of the year, they already know what they're going to do for the rest of the year.
Mm-hmm.
But very rich people think decade to decade.
Wow.
In 2020, they was thinking about 2030. At 2030, I want to have 10 hotels. I want to have 5 businesses. I want to have this. I want to have that. And the question is then, how do you think about money? What is your mind?
Wow.
How do you think about money is how you attract money.
Well, I need to change my thinking because I'm sure not thinking decade to decade. I am sure definitely not doing that. Danielle said that she'll say it for you. They made a trashy decision that affected a ton of little people. I'm going to say it since you can't say it.
Absolutely. Thank you for that, because that's exactly what happened. That's exactly, she's right. I mean, a lot of people got hurt, but this time it was just publicized, but it happens every day.
Yeah.
They do it every day. And it's not going to change. One of the things that to look for, and I tell people all the time, there's going to be a lot of volatility in the market. People say, well, the market is now low. You need to go in and jump in and make all this money. That's not necessarily true. You have 2 types of market. You have what they call a bear market, when you see the bear claw is down, which the market is down, and a bull market when the horns are going up. I know people have heard a bear market versus a bull market. Mm-hmm. A bear market is when the securities are going down at a rate of about 20%, and it stays that way for a period of 9 to 12 to 15 months. So that means everything's going down. Mm-hmm. They're dropping interest rates. They're doing everything. We're in a bear market now, and no one is willing to say we're going into a bull market, which simply means we hit the bottom, so there's nowhere else for us to go but up. A bull market is everything's been going up for about 9 to 12 months, 15 months, and everybody's going to make money. But what we don't know is the volatility of what's going on right now, because we've never had a pandemic in our lifetime. You have a pandemic, you have a new political party in place, which is going to change a lot of the laws that are going on, and it's going to be a lot of fighting. So it's going to be a lot of uncertainty, and uncertainty brings volatility, and volatility brings loss. So I tell people to take it easy, pump the brakes, wait till about June, and then we'll see where we are, and then make some decisions. Because just like today, people jumped on that, what is that called? The GameStop, AMC, and now it got beat up. Some people made some money, but for the most part, people got hurt. So I tell people to be patient, and when it comes to investing, you only invest money you can afford to lose.
Wow. Yeah.
Don't invest your mortgage money.
Yeah. I want to say amen to that. Amen to that. Can you talk a little bit about some of the products when it comes to finance in this last 30 minutes that we have? Again, if you all have questions, make sure you post them. Linda Aberin said mortgage rates are being reported at an all-time low. Is it a good time right now to do some refinancing? Sure, if it fits you. Again, this is not a broad spectrum. Your interest rates are low, but if your credit score is low, then it's not going to help you. So you want to make sure all your ducks are in a row and you find the right deal. Buying real estate is not just about the interest rate, it's also about the right deal. So yes, to answer your question, it would be ideal to do it if everything lined up. If you have a 680 or more, credit score 700 would be ideal, then you refinance. But the other thing is this. Let's say a person has been in their house 15 years. The first 15 years is 70-30. 30% goes to pay the mortgage and 70% goes to interest.
So if you're paying, you know, 70-30. So if it's $1,000 mortgage, $300 goes to pay the mortgage, $700 goes to the interest. So now you're on the backside of that. So let's say you've been in your house 18 years. It wouldn't make sense to refinance unless you're going to do it for a 10-year or maybe a 15-year. If it's going to drop your rate, your rate is going to drop your payment low enough that you can save some money. You know, don't do it because Johnny did it. Do it because it's beneficial to you. So hopefully that made sense, because it has to make sense financially for you to do it, not just because it's a low interest rate.
That's very good. Very good. So talk to us a little bit about savings and retirements and IRAs and 401ks and all of that. And how do we go about preparing for retirement? When is a good time to retire? Should we be doing 401ks? Should we be doing IRAs? What exactly? And I know that there's no one size fit all, but just talk a little bit generally about those products.
Sure. To start out with this, the best time to start saving for retirement is the day you start working. Because basically, what does it take to retire? Age, years of service, or money? And the answer to that is money. But if you ask most people when they're going to retire, they'll give you an age or years of service. So they'll say, if you ask the person, when you're going to retire? Girl, when I get 30 years of service, I'm retiring. But what if you don't have enough money? You just quit your job. So you have to go back to work somewhere because you don't have enough money. What if you get to age 65 and you still don't have enough money? You can't retire. So the goal should always be, when I get enough money to pay off all my bills and to live off of comfortably, then you can retire. And most people are on the wrong street. They're on the age and years of service street instead of the money street. So what you want to do is start contributing to your retirement account. They're called tax sheltered annuities. And a tax sheltered annuity is what the IRS calls retirement or pension plans, or I should say supplemental pension plans, because they give them a tax code. If you work in corporate America, it's called a 401k. If you work for a nonprofit, hospital, church, school system, it's called a 403b. If you work in local, state, or federal government, it's called a 457. And if you're self-employed, it's called an IRA. They're all the same thing. They're all tax sheltered annuities. You put money in and it comes out before it's taxed. So it does several things. Number one, it costs you less money. Since, you know, the more you make, the more they take. So it comes out before tax. So let's say a person makes $2,000 a pay period and they save $200 a month. So now they're not taxed at $2,000. They're only going to be taxed on $1,800.
Right.
So taxable liability. So it costs you less. So they take out less taxes. So it gives you more money. The other thing is it allows you to save more money for retirement. The earlier you start, the more money you have. You'll be building a money tree and not a money plant. So most people, literally, because you start out with something small and it takes years of watering it and putting more in it, fertilizing it so it can grow. And guess what it does? It can take care of you later. Right. Most times a plant can't take care of you. A tree can, but a plant can't.
You preaching, fella. Come on.
And I always ask you, do you want a money plant or a money tree? Most of us want a money tree because you can pull off a money tree and it'll replace itself. A money plant is pretty much done. And the other thing is this, it's 100% tax deductible. 401k, 403b, IRA. Whatever you put into it, let's say a person makes $50,000 a year and they save $5,000 at the end of the year in a tax sheltered annuity, then it only shows they made $45,000. Whatever you contribute to your tax sheltered annuity is 100% tax deductible. You know, you have 5 major tax deductions, son. You have a house, a spouse, a child, a business, or a tax sheltered annuity. Those are the 5 IRS deductions: a house, a spouse, a child, a business, or a tax sheltered annuity. You know people that claim other people's kids so they get that tax deduction, right? You claim your spouse, you can start a business. If you own a house, you write off the interest, or you can save money. Those are the ways you say reduce your taxable liability from the IRS. And that's the safest way to do it, is to save some money.
Man, I feel like I'm taking notes. Like this is a class, and man, so I would encourage you, if you are listening to this on the replay, just let us know that how this has helped you, or that you are listening in. This is vital information. Let's switch gears a little bit and let's talk a little bit about life insurance.
Okay, but can I say this real quick before we go to life insurance?
Yes.
Our community does not participate. We're the lowest participation in the 401k program. The reason why is that we don't understand it. It's not that we can't afford it. We just don't understand it. And we don't do what we don't understand, because they send you a statement that has a little pie circle with the different pies and allocations, and it confuses people. I tell people this: even if you don't understand it, you don't understand how electricity works, but you still turn the light on, right? So you need to participate, because most companies will match it. And that's one of the few places you get free money. So they have a 1-800 number, and they actually pay people to help you manage your 401k. Most people don't know that. And they pay them. And you're paying them anyway, because they deduct it before managing your funds anyway, monthly or annually. So you need to take advantage of it. So I encourage anyone who's listening to participate in your 401k, because that's the one thing that's going to help you to build your money tree and financial success down the road. So
let me ask, so now somebody wants to know, Yolanda says, what's the difference between a Roth IRA versus a traditional IRA?
Great question. Traditional IRA comes out before taxes, and it reduces your taxable liability, and it grows tax deferred. So you don't pay any taxes on until you actually use the money, which is usually when you retire at a retirement rate, which is a little bit lower. A Roth IRA, you pay taxes as you go, so you don't have to pay taxes when you take it out when you retire. So you would typically have a Roth IRA, and you would use those funds first before you touch your traditional IRA. The biggest challenge, though, in our community is lack of education, because you have people getting rid of their traditional and paying taxes to get into a Roth, which didn't make sense. What you could do, you need both. It's not an either or, it's an and. Because what you want to do is you want to spend as much of the tax-free money. It's not really tax-free because you're paying taxes as you go. But when you go to take out the big money, you're going to take it out at age, what they call 72 and a half, is what they call RMDs, when it's mandated to take money out. You'll have a whole lot more, because that money has never been taxed. It wasn't taxed when you earned it. It wasn't taxed when you saved it. It's not going to be taxed until you actually take it out. So it can grow a lot faster than money has been taxed along the way. So the difference is one is taxed now and one is taxed later. But the one that's taxed now helps you because it reduces your taxable liability, so that you can use that money to save into a Roth IRA.
Wow.
So they work together.
She said, thank you. Wow.
You're welcome.
That's really good. Are there any other questions? We're coming up on our last 17 minutes. You know, I don't like to keep you on too long. You know, we have stuff to do. Earl, if you would tell us again, because we have some people that came on late, tell us again about your services.
EMO Financial Services, we're a full financial planning firm. We deal with life insurance, we deal with retirement planning, financial planning. A lot of people don't plan. Let's say, for example, when a person passes away and they get a lump sum of money, they usually allow the banks to deal with that, which is, in my opinion, not a good idea. You need a financial planner. You need someone that can help you and walk you through that process. We help you from A to Z, whether you're working, whether you're retired, thinking about retiring, planning for your kids' education. We do full financial planning from A to Z. More so now, 80% of it is more retirement planning, but we can do everything from A to Z.
And I have to give a commentary. I know that when my sister died, I called on Earl. And I remember, Earl, we had a sum of money that we wanted to put away and let it grow. And I called Earl, and he gave me several options. And he told me which one he thought was the best, you know, how long it was going to stay. It would double the amount that we put in, and it actually did. And the time went by pretty fast. When I tell you, he has a wealth of information. Even small amounts of money, he can make it grow. Make it grow.
Listen, I'm a Black financial planner, so I had to get used to working with small amounts of money. I work with large ones. I prefer large, but I work with the small ones too.
You talking about making $1 holler, honey.
I like that.
I have to say that I am very thankful to him and his entire family. They have just been a blessing to us, personally and professionally. I really thank you for that. So in our last few minutes, let's talk about insurance.
Okay.
You know, we sometimes we only have insurance on our jobs, and sometimes we don't keep those jobs. And talk about different types of insurances, life insurance that we should have.
Okay. And it's funny you say that. 80% of the African American community is either uninsured or underinsured. What is uninsured? Just don't have anything. Underinsured is just you just have it at your job. And most people tend to leave their job, or even when they retire, they're no longer insured when they leave their job. So you need to have your own personal insurance. And I think the earlier you get it, the better. Because the younger you are and the healthier you are, the cheaper it is. And all insurance is based on age and health. So our goal with EMO Financial Services, we try to get you the maximum amount of coverage for the least amount of money for the longest period of time. Because that's what we all want. Everyone loves life insurance. We just don't like the premium. We don't want to pay for it. Everyone, why? Because we want our families to be taken care of if something happens to us. Mm-hmm. You think about it like this. If someone were to pass away, you're going to put your family in one of four positions. One, you have no insurance. So you're going to leave your family broke. Let's say you have a little insurance, which is, let's say, $5,000 to $10,000. You will just be able to bury them. You have no insurance, they'll be broke. Little insurance, you'll be able to bury them. Let's say you have a little more insurance. Let's say $25,000 to $50,000. You'll be able to bury them and pay a few bills, right? The fourth position, and the position we all want our families to be in, is they have $100,000 or more, you'll bless them. So you're going to leave your family either broke, be able to just bury them, be able to bury them and pay a few bills, or you'll be able to bless them. And the difference is the decisions we make now to make sure that our families are covered later. Because I always say this, I don't want nobody else rolling up in here after I'm gone. You're like, no, you can't come up and he's still taking care of us. We good. Our house paid for, everything good. but honestly, there's multiple insurances. In the beginning of the time, they had just one insurance called Whole Life. That was the life insurance that went from age 0 to age 100. But it was the most expensive. It was like buying a Hummer. Yeah, it was designed to cover you to age 100 because it was designed for your retirement. It was designed for education. It was designed for death. It was designed for everything. It's an expensive insurance. Then they came up with term insurance. What's the cheapest? Like buying a Honda. It's the cheapest you can get, but you only gonna have it. You're renting it. You don't own it. You just rent it. 5, 10, 15, 20, 25, 30, however long you need it. And term insurance is great because you can customize it to fit your need when you need it. Then you have what they call a universal life insurance, which is a hybrid. It's like having a hybrid. It goes to age 95, but costs less than whole life, but costs a little more than term, but it covers you for the duration of your whole life, but it's a little less expensive. So people say, well, what should I get? It really depends. Again, you got to look at your situation. If you're married, 30 years old, you have 3 kids, you don't need to be buying a whole life insurance policy. That's going to cost you $300 a month for, let's say, $1,000. But you don't need to buy universal life yet either, simply because it might cost you $150 a month. Well, you can get a term policy for 20 years or get it for 30 years. In 20, 30s, it's amazing. They cost pretty much the same, like $1 or $2 different. But you want to get your kids the maximum amount. You might be able to get $500,000 for the same dollar amount. So in case something happens, because insurance is designed to be income replacement. That's what it's designed to do. So let's say a husband were to pass away, he's 30 years old, he needs $500,000 worth of life insurance to make sure his family, the wife, can take care of the kids and keep it moving. So you don't want to undershoot it and say, well, I'm just gonna get 100,000. How long do you think 100,000 is gonna last you if you got three young kids? You know what I'm saying? You got a mortgage, you took two to pay the bills, now it's only one income. But I'll say this in defense of the African American community. We were lied to when it came to life insurance. We were sold a bill of goods. We were sold bad insurance. It was called debit insurance. They used to come knock on the door, and Big Mama and them had insurance, and they paid $1.50 a week and all that, and they passed away and they got $1,500 worth of life insurance and then paid $15,000 for it. You know what I mean? So when you go to bury them, he said, man, life insurance don't work. I ain't gonna buy no life insurance. You can't even bury Big Mama. But the reality of it is, on the other side of town, they was giving them $100,000 worth of life insurance for the same premium. And they would sit around the table, you get 20,000, you get 20,000, you get 30,000, we bury Big Mama, and everybody lives happy ever after. So we're behind on the 8 ball, but we've got to understand insurance is nothing more than a check waiting to be cashed for a loved one when you die. So the question is, how big do you want the check, and how much do you love your family?
Wow. Wow. How big do you want the check, and how much do you love your family?
Right,
I think
determines the
is a good bit. I told him I'm not doing any more insurance for you all. This should do it.
This should do it, right? And again, everybody's situation is different. Some people are not married, no kids, so you don't need $500,000 worth of life insurance. You just need to get buried, and if you got a few things you want to make sure they pay off, you want to leave to a loved one, that's fine. But if you got 7 kids, you better be getting some insurance. Or live a long time. That's one of the two.
Hey, so Janice, on that question about ain't nobody else moving in your house, she was like, yes. She said nobody else is moving in. You're good. So is there anything that we did not cover that we should cover when we're talking about finances? Oh, we didn't talk about this. We didn't talk about college savings accounts. You know how some people put money specifically for their kids to go to college, and they can only use it for that?
It's called a 529E plan. I'm not a fan of it because if you don't use it, let's say your kid gets a scholarship, a full scholarship, pays for their books, tuition, all that. If you take that money out for anything other than school, books, tuition, housing, then you're penalized. So I would always encourage, especially in our community, put that money in a traditional annuity, put it in the IRA. If there's an education fund that's not a 529E plan, that's good to do as well, because you may not necessarily they might not need that money for that. You might want to use it to buy them a car. You know what I mean? So, and not for books or tuition, but you're penalized because it's only geared toward those specific things. So I think this, and most people are not in a position to save based upon the cost of education, to pay for their kids' education. They need to save enough money to supplement that. Mm-hmm. Now, don't get caught up in, I want to save, most people can't afford to save for their kids' education because tuition is about $20,000 a year. So that's $40,000, $80,000 for 4 years. And that's for one child.
Right.
So now if you got 2, that's $160,000 that you're going to write a check for. This is what I encourage them. Make sure your kids get good grades, get scholarships. Your job is to do your homework. You get good grades. That's what you do. And then you can supplement that because, we've been blessed and fortunate that our kids have done that. And we're able to supplement their education. So they graduate with no student loans. Manny was talking about the guys he's graduating with this year. Most of them average between $100,000, $200,000 worth of student loan debt when they graduate.
Wow.
So, and it's just amazing that we just paid Janelle's tuition last week. She called me on the phone, hey, Dad, it's my tuition. So we just pay it and keep it moving. She gets good grades. So, that's our reward to them. They get good grades, we're paid for it. And we're blessed to be in that position. Don't let anybody feel guilty, but that's what you save for, to supplement. Don't get in the mindset you can save to pay their whole tuition, because the average person can't afford to do that. Not in 2021.
Yeah. Wow. Man, this has been fantastic. Anything we left out that we need to cover or you need to cover before we end this? This has been great. You all have any final questions? We got about 5 minutes before we end this. Any questions? Any comments? Come on and share them now.
While you're looking for, while they're going to put those questions, I do want to say this. Money, it is a mindset. And how you think about money is how you utilize money. It's easier, always understand it's easier to get your hands on money to keep your hands on money. It's easier to get money than it is to keep money. And we see it all the time with people who win the lottery. They win for $1 million or $500 million, whatever the case, they're broke in a few years because their bank account changed, but the mindset didn't. Wow. So if you think poor, you will be poor. If you think wealthy, it's just a matter of time before you build wealth. So you have to change your mindset and think wealth and you will attract wealth as opposed to thinking poor. And this is what I always share with people. Stop taking advice from broke people. Because and I say that, and I say it jokingly, but I'll say this and I'll maybe take a question. When you're going to make a financial decision, buying a house, a car, or something of a big magnitude, who do you consult with? Your girlfriend, your guy friend, your boys. And what do they say? Man, is it nice? How do it look? How does it look? You like it? Never do they ask you, can you afford it? What's the rates? What's the terms? But if you're talking to somebody who deals with that on a daily basis, that's the first thing they're going to ask you. Can you afford it? What's the rates? What's the terms? So broke people, they like to party, but they can't give you good financial advice. And they love you, they just can't help you.
Yeah, amen. So you have a question here. It says, how do you guard yourself with life insurance as it decreases when you go from 65, 70 to 75? I guess when you get that old.
Well, this is the thing about life insurance. Most people don't understand it. So you have to keep up with it. So let's say a person's insurance, some companies, and now it depends on the company you have. Some companies are horrible because when you get older, they either raise your rate every year or they decrease the face value every year. You want to get a life insurance policy that the premium remains the same and the death benefit remains the same for the duration. So let's say a person gets a policy at 50 and it goes to age 80. Everything should stay the same until they reach age 80. Nothing should change. But some companies, when you reach age 65, they start decreasing the face amount and increasing the premium amount. So basically what they're doing is trying to run you out of it. You realize only 40% of people in the world cash out life insurance policies. They just outlive them, like I said, they live past the 30 years and never renew it, or they just drop it because they can't afford it. So we need to make sure that we sacrifice and sit down with someone who can give you different plans to fit you. Not what fits your neighbor, not what fits your family, but what fits you. And then put together a successful financial plan, not only for your money, but also for life insurance as well.
So we have one person that wants to connect with you. Can you give them your office number or the number how they can reach you?
Sure. They can reach me direct. My office is 678-916-5492, 678-916-5492.
Can somebody type that in the chat for me? Let's see, can I type it?
And then let them know that they were on the show too. So that way I'll know.
678?
916?
916?
5492.
Let's see. I think I got it. All right.
Udabomb.com.
You the bomb, sir. Well, thank you so much. Oh, Danielle had to be all fancy. Can you see this?
I can't see it. I don't know. Listen, I'm a novice when it comes to this. I'm learning. I'm like you. I'm learning.
Operator error. Yes. Yes. So, well, thank you so much, Salt and Light. Gloria said, thank you so much. Gloria Davis, thank you for logging on. Thank you for being a part. Thank you, Sophie and Jan and Yolanda, all of you all, Pam and Esther. Davis Wilder, thank you for logging on.
Say hey to my cousin Esther. Tell Brother Jameson I say hello.
All right. Well, I heard you. Linda Albritton, Sophie, Lydia Green, Lisa Green, Janice, I said Janice, and Danielle, Brenda Jordan, thank you for being on tonight. This has been great. Pam, thank you for being on this conversation. Quincy Watts is watching. Thank you, Quincy, for joining us tonight. Remember, and Kim Dejanay, man, I hadn't talked to you in forever. Linda Atchison, Gregory Jones. This has been a fantastic. Teresa Blunt, thank you for joining us. And my cousin Curtis, this has been a fantastic conversation tonight. I am so glad that you were able to come on and you were able to provide some just sound advice. I would encourage people to share the broadcast so that others can hear. Janice said, thank you, everyone. Esther said, thank you. Linda said, this was great. Sophie said, thank you both. Pam gave us some hearts. So it was great information. It made me think about some things that I need to change immediately. You don't know how I just get tired of cooking every day.
Hopefully it was helpful.
It was very helpful.
I hope it was helpful.
Danielle said we should do a financial panel in the next few months. Well, okay, I'm cool with that. Danielle published a book from a young lady that did a financial, I think it's 31 days of financial planning or something dealing with finances. Okay. So, but I'll be happy to do that. But again, my friend, thank you. And you stay safe, stay sanitized.
And stay sane.
And stay sane, and stay 6 feet apart. And
that's
wear
right.
your
I like it.
Wear your mask. Put that mask on. All right, yes. My friends, you all stay safe, stay sane, and stay sanitized, and wear your mask. And I will see you in a couple of weeks, and we'll have another great broadcast. All right, you all. Earl, you hang on, and I'm going to hang up. You all have a great one, and I'll talk to you soon.